to public accounting people here. And you covered some of this, but just to clarify, what are some of the biggest financial reporting risks to consider and hurdles to overcome when going public, especially via SPAC?
Tracy, I think you're on.
Tracy,
You're on.
you-
Yep, you're on.
Sorry, it's like pouring here in this part of Chicago, so I put it on mute. Maybe from just starting point, just thinking about what you would normally need to do to get to an accounting perspective to be ready to be a public company. You need to evaluate your accounting policies, and part of those are some of those accounting policies that you maybe hadn't paid attention to. So you think about segments. You think about how you calculate EPS. Adam mentioned having a really strong cap table in place. That's going to be important for both pre and post the transaction. Also thinking about your revenue recognition to make sure that you've gone through and really adopted the disclosures that are required of a public company. There are different levels of disclosures. Stock-based comp is a real big hot topic right now. We're continuing to see, the SEC just kind of asking questions around how you're, valuing those and fair valuing and making sure you have a, strong case to be able to, protect the position that you've taken in the financials. Thinking about the financial instruments that you have and if their, classification is appropriate as well. And then obviously you have a huge section of MD&A that also needs to be thought through as well. We are seeing some recent issues just in general. The SEC has been probing and asking questions around warrants and valuations, especially as it relates to some of the equity instruments that the SPAC has. So it might not be an operating company problem, but when I mentioned earlier that you're inheriting the accounting of the SPAC, in many cases, you are inheriting their equity structure as well. And so making sure you have a good understanding of that as well. Just really important to do, a full assessment from an accounting perspective. Chris, I don't know if you have anything else.
Well, so I would just add that. So about a month ago on March 31st, the SEC's Division of Corp Finance published a letter, as did the acting chief accountant, actually on the same day. And they both mentioned a number of things that they are really looking for and that they kind of warned companies to sort of watch out for. And it's all the things that we just talked about. So it's things like, can the company meet SEC reporting requirements? Does the company have an effective, budgeting and forecasting process in place? Does the company really understand its controls? And is the company ready to be compliant with the Sarbanes-Oxley Act? Does the company have adequate IT systems and adequate infrastructure in place? And does it have the right corporate governance in place, as Adam mentioned, a while back? So does it have a board? Does it have an audit committee? All those kinds of things. And so I sort of took both of those two letters to mean that the SEC is trying to pour maybe a little bit of cold water on the SPAC market right now, because frankly, I mean, let's face it, I don't think the SEC is overly excited about it, and I don't think they really like the fact that there are so many companies going public via SPAC as opposed to taking sort of the traditional sort of paced out IPO process. And so I think that that by those statements, like I say, I think the SEC is trying to pour a little bit of cold water on it, and they're sort of, telling us what they're going to be looking at, especially as they're looking at the Super 8K filing, at the S1 filing and S4 filing and all that kind of stuff. So, I guess that's what I would just say is we've said it a million times, but a company's really got to make sure that they've got their ducks in a row. The SEC's got their spotlight on SPACs, so it's just important to make sure that companies are thinking that through.
Awesome, thank you. I'm seeing several questions coming to me in the chat. So if you guys have anything based on what they've said so far, I just have a couple more questions left, but put them into the chat and I'll make sure I will get to them in a little bit when we do the Q&A part. Shaan, how have SPACs performed in the long run versus companies that have gone through the IPO route?
It's an interesting question. I mean, it's somewhat of a mixed bag. I think, SPACs recently, like we've obviously why we're here today, is they've gotten a lot of attention because we've had, some successful, really successful SPACs like Virgin Galactic, DraftKings went public through a SPAC. Another one is Nikolai, for electric vehicles. So, but, for every one of those kind of success stories, what you find is, in general, it's going to come down to the actual business, and here I think someone asked in the chat, the risks associated with, SPACs versus a traditional IPO. Adam touched on this too. A lot of times, it's really a capital raise for a lot of, early stage companies. that may not have access to capital otherwise. And often that means, you don't have full proof of concept, you don't have a fully baked, business plan, or you haven't, so there's usually a reason why you're going that SPAC route versus the IPO. So you're not getting all that scrutiny. You're not going on a roadshow with potential institutional investors and really selling yourself, to, all the institutions and the folks that basically vet, the process. And that's why, in that traditional IPO process, you eventually arrive at a, IPO value. Whereas here, if SPACs typically when they go IPO, they list at $10. So that'll be, and they could trade at $10 for, this entire 24 months while they're trying to find an acquisition. And then typically as soon as there's, either rumors or the announcement is made of who the transaction is going to be, if the market likes it, you'll see a big pop in the, in the SPAC stock. It'll go from 10 to whatever. And if they don't like the deal, more often than not, it'll go below the $10 listing price that it started at. So it's kind of a mixed bag. And I think, there's obviously, as an investor, there's risks that are associated with investing in a SPAC. I think, the nice thing that Adam, which is very important, which Adam mentioned, is, you have the option to redeem your, your shares and get out when the, announcement is made if you don't like the, potential company that they're going to merge with. And here's where kind of the promoter of the SPAC and the executive team behind it, really matters, because at the end of the day, they're basically the ones who are rubber stamping this merger. Like I said, you don't have a roadshow. They're not going to all these different institutions and selling themselves. It's really this management company that, arrives at a valuation with them, and then they line up the financing and so forth like that. So, it definitely is more risky, and I would say it's not for everyone. And you really have to look at the underlying business that the SPAC is merging with to really understand if this is going to be a successful transaction, or, let's just face it, as a promoter of a SPAC, you have kind of a, you've got some ulterior motives too, and a conflict of interest where if you don't, do something with this SPAC in 24 to 36 months, that money goes back to investors and, you're not left with anything. So I think it, sometimes leads to bad decisions when it's getting to that kind of crunch time. And you'll see a lot of SPACs will initially go in and say, we're going to do acquisitions in the auto space or the, energy space. And then when they can't find transactions in those spaces and they're getting close to their redemption period or expiration period, they'll pivot and go to a completely different industry. So it's really a mixed bag. And I think it's, you caveat emperor, you gotta kind of dig in and do your homework before you go and invest in one of these deals.
So like the last 3 years, like the companies that have gone public through a SPAC versus the companies that have gone public through an IPO, let's just say last 3 or 4 years, whatever time period you want to use, like how have both, like how they performed against each other?
I think once again, it's really, it's hard to kind of have that comparison because, it's not quite apples to apples because, with IPOs, like once again, you've got kind of a vetted, business. Usually you have profitability, unless it's tech or something like that. But, it's I'd say, for every SPAC that probably does really well, you've probably got 2 to 3 or 4 that, end up failing. And that's because, the business wasn't ready to be taken public, it wasn't ready for the scrutiny. And what happens as soon as, you take a business that's not ready to go public, investors start heading for the exits, share price drops, and, it's kind of like just a cycle. So. Got it.
Now getting to the cannabis side of it, with everything that's been going on the last couple of years, SPACs have been really popular in the cannabis industry, especially 24 months even. Why is that the case? And do you see the trend continuing? And how have cannabis SPACs performed?
Yeah, so I mean, one of the biggest issues that the cannabis industry faces is because of its federal illegality. They don't have access to capital like traditional businesses do. So, a cannabis business that starts, can't go to their local bank or, a JP Morgan or a BMO and be like, hey, I want to, take out a loan, even if they're generating, real revenue, profitability. You just don't have those avenues. So, often they're left with, sale leasebacks, which are, expensive in the long term, or they take on really expensive debt that usually has some warrants with it. So it's just not ideal. And so that's why SPACs have kind of come in and kind of fill the gap in that kind of to provide capital to this industry. So in the last 4 years you've had kind of numerous SPAC deals in this space, even more recently. So it was announced I think about a month and a half ago. Hugh Wrigley, formerly of the Wrigley family, who started a cannabis business in Florida. They are going public. It's going to be renamed Parallel, and they are going public through a SPAC that was actually started by Scooter Braun, who is Justin Bieber's manager, a company called Series Acquisition Corp. So they're in the process. They've already announced it. And that's one. Jay-Z was another celebrity who did a SPAC in the cannabis space, and acquired some businesses in California and then used that to launch his own cannabis brand. And then, there's been a couple that have actually probably the most successful cannabis SPAC in the space is a company called AYR Wellness. So when they started, it came out as AYR Holdings. It was listed at $10. They initially started with acquiring some cannabis businesses in Nevada, and now they've gone from just being in Nevada to being a top 5 cannabis company in the U.S. So it still kind of remains to be seen. If these companies that have gone public through the SPACs in the cannabis space, will succeed long term. I think they will. I think generally they have good business fundamentals. They've got a proven concept. They've got brands, and they've got a captive consumer audience. The issue there just really is they don't have the normal avenues to go and raise capital, and IPOs really aren't an option either because they can't even list on the New York Stock Exchange or the NASDAQ. They got to go do a transaction in Canada, which obviously leads to other issues. You don't have liquidity, you don't have institutions that can come in and invest. So, SPACs, I think, are going to continue for the foreseeable future in this space. There's actually, I think another one that was announced last month, and they've already announced a deal. So I think the trend is going to continue because, unfortunately for the industry, until there's regulatory change, at the federal level that allows, access to banking, which, actually is in the Senate right now, the Safe Banking Act. The hope is once that passes, then, you kind of have more traditional avenues of capital available to you. And then maybe we see, SPACs not be as popular, but I think, it's the rage in every industry right now. So I don't see it going away.
Yeah, no, that makes sense. Adam, last time we talked, you said the word DSpec. So I'll just ask right now, what does the DSpec process look like?
Yeah, I don't know who came up with this term, but it's not the most eloquent.
I heard it from you, so I'm not sure.
Yeah, if you heard it from me, it must have been my creation.
No, it's a generally used word.
I know, you're just kidding. It's basically the transaction, the merger transaction, to take the SPAC is really the blank check company, and so when you DSpec, you make it not a SPAC anymore by merging it with the target company, and then the target company becomes the public company essentially. So that process, is I think everyone's been talking about it. It's in my opinion, it's generally a kind of a 4 to 8 month process. Putting aside preparation, if there's a lot of preparation needed, and audited financials are needed, and corporate cleanup and corporate governance is needed, that you can add on to that time frame at the beginning part of it. But generally speaking, I would say a 4 to 8 month process, with the first 1 to 2 months being kind of engaging an investment banker, searching for the right SPAC, negotiating a term sheet or an LOI, getting a data room populated, preparing a draft merger agreement and negotiating a merger agreement. I think all that stuff would happen in the first 1 to 2 months. And then also if the transaction does involve that PIPE offering, which I talked about, that investor presentation would get prepared, and that process would begin. And so then after that period, the merger would be announced. And then phase 2 would begin, which is kind of the regulatory review and the marketing phase of the transaction. So the proxy would get prepared and filed. SEC would review it, comment on it, and there'd be a handful of back and forth turns of the proxy statement before that gets finalized and published. And then the more general PIPE offering would take place. And that PIPE offering, by the way, usually would take place in 2 phases, one being a much more potentially strategic PIPE approach, where you would where the bankers would approach strategic investors as opposed to institutional or hedge fund type investors. And then there would be the traditional hedge fund and institutional investor phase of the PIPE offering. The benefit of using strategics is the long-term approach. Sometimes the hedge funds, as many of you know, can be in and out fairly quickly, and which doesn't really lend well to the stock, post DSpec.
Can I ask you a question on that, Adam?
Yeah.
Actually,
Yeah.
something I've been wondering, like, do SPACs typically, the DSpec, do they typically have like lockups on, the insiders and the owners to, 6 months, 12 months, or 18 months on, disposing of the shares?
Yeah, that's a great question. There are lockups, and many of the more material all shareholders will have some sort of lockup. More material shareholders will have a longer lockup. All of that, the lockup periods, and including the sponsors, right, of the SPAC, all of the lockup periods are negotiated at the LOI stage. But there certainly are lockups to restrict, to avoid some of that, pump and dump type of trading. And then finally, the third phase is after all of that's done, the proxy statement is approved and made public. There's about a 1 month period where that proxy statement is sent to the shareholders. They review it, they vote on the transaction, indicate whether or not they're going to redeem their investment. And assuming all goes as planned, the transaction would close. So 4 to 8 months in total. DSpec, not the best term, but it makes sense.
Oh, it's that simple, huh?
Kind of like deplane, like get off the plane. Here, we're going to get off the SPAC.
Shaan, I have one final question, and that's for you. And it actually kind of goes hand in hand with a couple of people just asked me personally in the chat too, is, so why do investors provide equity and capital to SPACs and their promoters without really knowing what the actual investment transaction will be?
Yeah, I mean, it's kind of very similar to, investing in a hedge fund or a private equity fund, right? You're going off the reputation and the track record of the promoters of the SPAC. Basically you have confidence that, one, they're going to find a good, operating business to merge with. They're not going to overpay for it. And then, they're working to, get the best deal done. And hopefully that leads to then, success after the DSpec. And that's why you're seeing a lot more of, and who's to say, like, I find it a little, I don't know if I buy into all these celebrities that are popping into, starting SPACs. Traditionally it's been, folks who were in industry, executives, you were CEO of a large Fortune 500 company, you retired and you're like, oh, what do I want to do in my kind of moonlighting in my, next phase of my career? And it's like, you get, some of the other executives and team members you worked with, and you basically put a SPAC together, not too similar from putting together a private equity fund. And then you go out and try to execute on, the things that best, the industries, the products, the businesses. And that's what you're betting on as the investor, is that, these promoters know what they're doing. They have a successful, track record of success. Often, if you're successful in this industry with SPACs, you see, like, Churchill Capital was one that was kind of all the rage early part of January. They're acquiring Lucid Motors, which is a electric vehicle company. And, their SPAC went from, their listing went from $10. So at one point it was like $60 on the rumor of it. And now it's back down to 22. But there, once again, it's, the folks believe in that because they believe in the, sponsors of the SPAC. This is, I think, their 4th SPAC that they've done in the last few years. So, obviously if you have the success and you have the track record, you'll attract investors. And I think that's why investors are willing to make that, that risky investment in a SPAC, because they're hoping that, they're going to repeat that success that they've had in the past.
Awesome. Thank you. Anybody have anything to add to what he just said? No? Good. Cool. So we'll get to like some of the Q&A stuff. So if you guys have any questions, obviously just type it in there to me. But I will say all 4 of them are experts in what they're talking about right now. So if you do want to get to know more, like from them individually, I would highly recommend, since everyone's at their computer right now, just feel free to send them connection requests on LinkedIn. They've said I could say that. So yeah. And I think that might be the best way to get a hold of them. And one of the questions I just got is someone saying, I would love to know more about a company that's top line was 14 million and got a 1.5 billion evaluation. So I think, Adam, you talked about that, right? And yeah, I'm actually curious about that too.
Yeah, unfortunately, I can't say much about it.
Oh man, okay.
That would be, don't want to breach any securities laws here. But what I can tell you is, one of the benefits of the SPAC transaction is the ability to use projected revenues, like on a 3 or 5 year basis, where I think, and correct me if I'm not a capital markets guy, but any of you guys, if you know, I don't think that works in a traditional IPO context, but I could be wrong. But I know that is a benefit to doing a SPAC transaction. So, clearly this company has, really high aspirations as to where their revenue can go over the next 3 or 5 years.
And I would just add, because, we're seeing, things similar to that. And I think some of that is coming from the fact that all of a sudden SPACs have presented a sort of competition to the private equity firms that normally would have been, or the companies normally would have been targets of private equity firms. And so the SPAC is another route for those companies to use in order to, reach their liquidity event. And then I do think that a lot of what, folks are investing in is that management team on the SPAC side, especially if they have a strong management team, like, the former CEO of Medtronic, put a team together in order to, create a SPAC. So I think companies are investing, or people are investing in not just the company that they're acquiring or that the SPAC's acquiring, but really in that management team and the strength of it. So I think that's driving some of that up too. So, and certainly the celebrities, right? They're driving up the prices too. So
I was just going to ask that, why are so many celebrities, and they're advertising it, right? They're talking about it. So is that just to get more people to invest in SPACs?
I mean, my take on it is I think it's a sort of a marketing stunt, but I don't know, maybe others have different takes on that.
Yeah, I'd agree with Christopher. I mean, I think it's, part of it's marketing, part of it's, promoting they're promoting their brand, and now it's an extension in finance and investment. And, I think they are trying to capitalize on that captive audience that they have, that they speak to. I mean, it's, no different than Elon Musk when he goes online and tweets about a stock or Dogecoin or something like that, right? It's kind of the same thing. And, if they can, more often than not, though, they are involved with like real professionals who, actually know what they're doing and have a track record. And, they're kind of the public face, because obviously, do you want to see some banker, or do you want to see Jay-Z up there? You probably want to see Jay-Z.
Yeah, and they're not stupid. These guys know how to capitalize on their networks, and the promote that the sponsors get as part of these transactions is, as Shaan mentioned, 20% is huge. So it's lucrative, and if they can get it done, it's really worthwhile to them.
Cool. I have another question. How easy is it to redeem your shares in a SPAC? Is there a lockup period?
I'll take that. So the redemption, if you redeem, there's no lockup period. So upon the announcement of the transaction, there will be a bunch of paperwork that gets sent to the shareholders, and they have the option to redeem at that point. But of course, you can certainly sell your stock at any time. It's publicly traded, so you can sell.
Okay.
Yeah, for instance, I mentioned that that SPAC, the traditional capital SPAC, when it ran from like $10 to $60 earlier this year, a lot of people sold it at 60 because they were like, well, even once this transaction, the DSpec happens and it starts trading, then the company actually has to deliver to those projections and meet all those things that got it that huge. And I think this one was valued at 15 billion. So this was a $15 billion SPAC deal. So those are lofty expectations to live up to. And that's where usually, you usually do see, if there's a very positive reaction to it, by the street, you usually see a run up in that, price right after the announcement. And, a lot of folks will head for the exits because they're like, well, I just made, 2-3x my money in, a matter of months or, a year. I don't want to wait around to see how this goes kind of post DSpec.
Okay. If you're an ordinary investor that, obviously not a day trader, but someone that invests in stocks for, long-term, meaning like a year before selling it, and you how do you go about finding which SPACs to invest in?
I guess I'll start. I would look at like what we've been saying. Look at the management team. That's really what you want to invest in. Don't just go find any SPAC that's out there. You can do a simple Google search, or just SPACs, current SPACs or whatever, and dig into the management team, see where they come from, what they've done. Have they had success? If they were running, a big media company, like I think, the ex-Disney chairman, like Michael Eisner, he had it SPAC at one point, so it's like, that's what you're really investing in, is the vision that this management team has, and the, the confidence that they can actually go out and deliver and get an acquisition at a good price. And then, that once it de-SPACs, this business will continue to perform, and you're going to hopefully continue to see the share price rise. But you can't just go blindly. I think that's where you got to do your homework. I mean, it's not as, all the information is not going to be available to you. It's not as simple as saying, well, I like Apple, I'm going to go buy Apple. It's like you really don't know what you're buying except for that management team. And then like Adam said, you have the option to hit the exit if you want, once that transaction is announced.
Yeah, right. And you can follow, just as Shaan said, you can follow all of this on the on Google or any kind of, you can set an update. You'll see 4 or 5 of these pop up every day, and you can kind of look at their documents on the SEC website. SEC has a system called Edgar where all the publicly filed documents are stored. And so when you find one that looks interesting, you can look up their S1, their initial registration statement, and read about the management team, read about kind of what their plans are, because each SPAC will have its own website, but the website is generally pretty limited in information. And actually, the website should, if they've done it correctly, link to the Edgar website, so it should make it pretty easy for you guys.
Cool, thank you. I think I've answered most of the questions. Oh, I have one more. This was sent out earlier. So, and I told you guys when we first started that I didn't really know what a SPAC was until the end of last year. And someone had asked, why are SPACs, I guess the best way to ask this question so that kind of, you're not repeating yourself, is like, when did SPACs start? Like, when did companies start going? What year did companies start doing SPACs? And is it like it's grown so much right now? But was there anything in particular that literally made this grow exponentially? Because I don't think a lot of people have heard of this until the last year or so.
I mean, SPACs have been around for decades. I mean, I want to say SPACs have been an acceptable way to go public probably since what, the 70s maybe. Something like that. So they've been around for decades, but it's just that the vehicle, or that particular vehicle to go public, really was not used that much. In the, I don't know, 70s, 80s, 90s, even the early 2000s, it was kind of really viewed as sort of a really risky type investment, because the companies weren't going through the traditional type of IPO process. So it was almost looked at as a little bit of a, I don't know, kind of a dirty type way to go public, if that's the right word to use. But anyway, I mean, but it's been around for a long time, and I guess I'm not sure as to why they've gained so much in popularity. Maybe some of my other analysts have that.
Yeah, I mean, I remember when I was, an analyst, like back in like 06, like SPACs were the rage back then again, and usually tend to follow the money cycle and the cycles. So usually when there's a big rush into SPACs and you're seeing a lot of SPACs being raised, just be wary of where we are in the cycle in the market, because the last time and they were not even near the level that we're seeing now, but the last time you had this much, this level of SPAC activity relative to where we were before was back in that kind of 06 to 08 time period. So it's usually, when you are in environments where there's a lot of excess capital in the market that's not, being put to use. So it's going into things like this or private equity. And, and like I said, more often than not, sometimes you end up with, businesses that, shouldn't have been taken public, weren't ready, didn't get enough scrutiny. And then, you're often, as the shareholder, left holding the bag, literally.
Yeah, and I mean, I think that's been the common theme that you hear all the time, is like there's so much money out there that people don't know what to do with it, and so they're investing in different things. And what you mentioned about 08, 09, I think about that all the time, because I don't know when it's going to happen, but I personally feel, my own non-expert opinion is that something is gonna happen soon, and hopefully it won't be as bad as it was in 08, 09. So, but any final thoughts from the 4 of you guys? And if there's any final questions from anyone that's out there, you could ask whatever. Feel free to put it in the chat. Final thoughts, you guys?
I mean, I'll say, SPACs are an interesting thing, and they're not going away. And I think, I think in general, they've gotten a bad name in the past because of, some of the transactions that went down and not doing a lot of diligence and things like that. But I think, once again, just, if you look and find the management teams that are, have successful track records, and you kind of stick with those type of, if you want to invest in this, space, and it's obviously risky, but just make sure that, you're betting on the teams that, have a track record, have had success, and, you're hitching your wagon to them, and, not just some random SPAC out there.
And maybe I would just say too, and knowing that there's a lot of CFOs on the call here, do your homework, do your due diligence. There's plenty of work to be done still if you go public, via SPAC, and so just make sure that you do your homework, make sure you do your preparation.
Yeah, and maybe one other thing just to be thinking about is a lot of times these transactions aren't necessarily right in your face, and so if you start to hear of different investment options, and maybe they aren't necessarily thinking about SPACs, but just thinking about making sure that you're aware of what the transactions that are being talked at your board level or with your other private equity, so that you're aware, so that you can prepare in advance. As there's a lot of work to be done.
Yeah, I echo everybody's comments. I think there's not much more to say other than, if you are considering going public by virtue of a SPAC, feel free to reach out to any of us to talk it through, and because there's a lot of detail and nuance that we certainly can't cover in an hour of panel discussion, but there's a lot of other considerations that you may want to think through before you make that decision and start engaging in SPAC conversations with SPACs.
Awesome, thank you. So just so everybody knows, this is like almost like a kickoff to some of the other things that I'm going to be doing. That's going to be more topics that it's going to be around the whole SPACs topic, I should say. There'll be a lot more like smaller group discussions and different thought leadership things that I'll be doing. So just kind of stay tuned for that. And if there's anything specific to SPACs that you would like to know more about, or whatever the case is, obviously reach out to any of these four, but also let me know as well, because anything that I do with Orion 3, I want to gear it specifically to what people want to know, what people care about. I don't, like I said, part of Orion 3 is to cut out the bullshit that we deal with every day when we're trying to find answers to certain questions that we have. So feel free to email me. And I just want to say thank you to the four of you for doing this. You guys, all four of you are extremely busy. I appreciate it a lot. And yeah, I'm getting a ton of things saying great information, very educational. Thank you. So cool.
And thanks to you, Benny, for pulling this all together. Really appreciate it.
Yeah, thanks for having us, Benny.
No problem.
Thanks, everybody.
Yeah.
All right, guys, have a good day.
Okay.
Thanks, everybody.
Bye, everyone.
Bye.